Hi everyone. Today's class is on types of capital rationing. In the last video, I introduced the topic capital rationing, in which I said we have in which I explained the causes of capital rationing. I define capital rationing as a constraint on, as limit on what to on budget, and also which is as result of what of internal factor or external factor. The internal factor which is a result of what of the management of the organization, while the external factor is a result of what to restriction, constraint on sources for fund in the market. The market such as the financial institution, the capital market, and stores. So I gave the causes as soft or internal causes of soft or internal cause. Also the second cause, which is what? The external or hard cause of the capital rationing. Soft capital rationing is the cause of the soft capital rationing is within the company, in which the company may decide as what to may have the ceiling for outflow for a particular period of time. That is, the company, we don't want to spend more than this particular amount of money in this period. So by that, therefore, you're going to place a restriction, a constraint on what to on the available projects. Okay, so where the external capital rationing is a situation whereby the market forces is affecting the company's source of fund externally, such as the restriction on what from the bank, in which the company may lack what good credit rating, in which the bank financial institution intends not to do what, not to give the company money to invest on projects. Okay, now we are on types of capital rationing. Basically, we have two types of capital rationing. You have the single period and the multi-period. As the name suggests, single period. This is a restriction on capital for a single period, for one period, which may be for a year, for one period. The period can be a year, as the case may be, as defined by the company. So when capital is what is limited in supply, when we place a restriction, is limited in supply for us to be able to invest on the available projects. We call it for just one period. We call it what, single period capital rationing. As we know that the rule under MPV is for the company to do what, to invest on any project that gave us a positive MPV. Or when this capital is not available, it's not what sufficient to invest on all these projects that gave us what, that gave rise to positive MPV. We tend to do what, to ration the capital, available capital on the project we have in the order of what, of importance, the order of their return, be it on what, on MPV or PI, as the case may be. So the second one we have what is multi-period capital rationing. This is a situation whereby the constraint on finance is span over a period. Span over a period. That is more than one period, maybe 2 periods, 3 periods, as the case may be. So that is what we call what, multi-period capital rationing. And under the single period capital rationing, there are some assumptions made under single period capital rationing, in which words it is said that what to under single period capital rationing, it is said that after the one period, capital, it is assumed that capital will be made available in abundance in what to after the single period. At least we are going to have enough capital after the single period, after the period as a lapse, after the single period as a lapse. Thereafter, we're going to have what enough capital to do what, to invest on. There won't be capital rationing as in the simple term, and there won't be capital rationing after this single period. So under the single period, it's assumed that we have the visible project. We have the visible project. We have mutual exclusive project, we have indivisible or independent projects, we have mutual dependent or joint projects. And all together, the criteria for making decision for allocating or for ranking projects under single period is the profitability index or the benefit cost ratio, which we have spoke about under the investment appraisal techniques. Now, what is divisible project? A project is said to be divisible where you can undertake parts of the investment. Take for example, if out of the 100%, the project is what? Is 100% in itself. If you can take parts, at least you can take 70% of the project, and at the same time, the benefit of that 70% benefit will also accrue to you. In a situation like this is possible, we call that project we call this project, kind of project, what? Divisible project, which you can do what? Undertake a certain percentage of the project, and at the same time, you are going to do what? Receive a certain a certain percentage of return from the project. Mutual exclusive projects. These are projects that cannot be accepted together. Two projects are said to be mutually exclusive if the two projects cannot be accepted together. It's either you leave, one project must go. Two projects are said to be what? Mutually exclusive. If the two projects cannot fly together, you have to let one go. So these are the projects as what we cannot accept the two projects together. One must be, if one is accepted, the other will be rejected. That's in simple terms. So indivisible or independent projects. These are projects that cannot be divided. It's either you accept the project 100% or you do not accept the project at all. Just the opposite of what of the divisible project, indivisible. So now you accept the project in its entirety or you reject the project in its entirety as well. Mutually dependent projects or joint projects. Mutually dependent. These two projects are depending on each other. If you accept one project, you must also accept the other project. That's what we mean by a mutually dependent project. Or you can call it what? Joint project. So when we are going to go in depth into what? Examining each of these projects on item by item basis. In order for us to know, to explain in detail what are the examples of the mutually dependent, what are the examples of mutually exclusive, divisible, indivisible projects. What? For explanation, mutually dependent projects are those projects in which you must accept one or more of the two projects. Two or more, and accept the two projects together. So the acceptance of one depends on the acceptance of the other one, the other project. So in making decision under single period capital rationing, that is, this is what I'm talking about here is which project are we going to do what to give this, which project is going to take the lead in the investment. Under the capital available, which project are we given are we investing on first? So the decision criteria will now be based on what? On profitability index. You have to compute your profitability index for any project under single period or the BCR, which you have spoken about. If you have not watched the video, kindly look for the video on profitability index. So watch the video and you understand what I'm talking about here. So as we go on, we're going to look at the project independently. From there, to understand better. Anyway, so multi-period. Under multi-period, we also have projects that are divisible under multi-period capital rationing. Now, I say that in multi-period, this is where the constraint is a restriction on capital, which span is a capital that span over one period. So this will lead us to formulating a lot of constraints. constraint for year one, for first period, for second period, as the case may be. So from there, we are going to formulate our objective function. We are going to formulate our constraints. So from there, we can then use what our linear programming to do what to solve for questions under the multi-period capital rationing. So this is an introduction to the types of capital rationing. We shall be looking at this subtopic under the single period, subdivision of what of the single period. We shall be looking at them in total. We shall be looking at them in detail in our subsequent video. So at this junction, I'm going to call it a class now. Please, if you have not subscribed to the YouTube channel, my name is Abdurrahman Adioye. Kindly search for the name on YouTube, subscribe to the channel, share the video, like the video, and also don't forget to put the comments, anything you have observed. And I'll be waiting and I'll be ready to do to respond to your comments. At this junction, invite your friend to do to subscribe to the YouTube channel. We are here to do to disseminate knowledge, to share knowledge, which I have. So invite your friend, your loved one, your student preparing for examination to do to subscribe to the channel and able to do to receive my subsequent video. And enable the alarm button so that when I'm posting new videos, you will be alerted on new videos. So at this junction, I'm going to call it a class. So thank you. Till we meet next time.